You open your investing app. You press buy. Seconds later, you own one share of Apple. But what actually happened? Did Apple receive your money? Did you become an owner? Or did your money go somewhere else? Surprisingly, most people who own stocks don't know the answer. And that's a problem. Today, we'll follow your money step by step and uncover what really happens after you press buy. By the end, you'll understand stocks better than most beginner investors. Let's begin. First, you need to know that companies don't always stay private. Some decide to sell ownership to the public. Why? Because growing a business costs money. Sometimes millions. Sometimes billions. Instead of borrowing huge amounts from banks, some companies choose another option. They sell small pieces of the business. Each piece is called a share. Buy one, and you own a tiny part of that company. This process is called an IPO, short for initial public offering. It's the first time the public can buy shares. When a company first sells shares, the money actually goes directly to the company. That's how it raises capital. That money can build factories, hire employees, create new products, or expand into new countries. But after the IPO ends, things change. The company usually stops receiving money from future trades. Now you're buying from another investor. And someday, you might sell your share to someone else. This buying and selling happens every day, millions of times, on places called stock exchanges. A stock exchange is simply a marketplace. But instead of buying products, people buy pieces of companies. Think of it like Facebook Marketplace or eBay. People list what they own, and others decide whether to buy. Every trade needs two people. Someone who wants to sell, and someone who wants to buy. Without a seller, you can't buy. Without a buyer, you can't sell. That's how every stock market works. But here's the next mystery. If buyers and sellers choose the price, who decides what one share is actually worth? The answer is surprisingly simple. A share is worth whatever someone is willing to pay for it. Imagine you own a rare football card. If someone offers $10, that's its value at that moment. Tomorrow, someone else might offer $20. Nothing changed about the card. Only demand changed. Stocks work exactly the same way. When more people want to buy than sell, prices rise. When more people want to sell than buy, prices fall. It's simply supply and demand. But here's something many beginners get wrong. A rising stock price doesn't always mean the company made more money. Sometimes people simply believe the company will perform better in the future. So they buy before everyone else. The stock market isn't just about today's profits. It's about what investors expect tomorrow. That's why good news can push a stock higher, and bad news can send it falling in seconds. Now you know how prices move. But owning a share means more than watching the price change. It means you own a small piece of the business. Owning one share makes you a part owner of the company. Even if your ownership is incredibly small, that means if the company grows, your tiny piece could become more valuable over time. Some companies also share part of their profits with shareholders. These payments are called dividends. Think of them as a reward for owning part of the business. Not every company pays dividends, but many do. So, as a shareholder, you can make money in two ways. The share price can rise, or you can receive dividends. But don't make a common mistake. Owning shares doesn't mean you can walk into the company's office and start giving orders. If you own one share, your ownership is extremely small. Companies often have millions or even billions of shares. That's why big investors can influence company decisions, because they own millions of shares. Some shareholders can vote on important decisions, like choosing board members or approving major changes. So buying a share does more than give you a chance to make money. It gives you tiny ownership and, sometimes, a tiny voice. Now here's the biggest question. If owning stocks can make money, why doesn't everyone become rich? Because stocks don't only go up. They can fall just as quickly. If investors lose confidence, they start selling. More sellers mean lower prices. Sometimes nothing changes inside the company. Only people's emotions change, and prices move anyway. That's why successful investors don't panic every time prices fall. They understand that short-term emotions don't always reflect long-term value. There's another mistake many beginners make. They think a low-price stock is always a better deal. It isn't. A $5 stock can still be expensive, and a $500 stock can actually be cheap. It depends on the business. Smart investors don't ask, how much does the share cost? They ask, what is the company actually worth? Because when you buy a stock, you're not just buying a number on a screen. You're buying a piece of a real business. That's why the best investors spend more time understanding companies than watching stock prices. So what should you remember before buying your first stock? Don't buy because everyone else is buying. Buy because you understand the business. Ask yourself, how does this company actually make money? If you can't answer that question, you probably shouldn't invest yet. Great investors don't gamble. They research. They stay patient. And they let time do most of the work. Because investing isn't about getting rich next week. It's about building wealth over many years. The stock market rewards people who think like owners, not people who chase quick profits. Now you know what really happens when you buy a single share. You're not buying a lottery ticket. You're buying ownership. Every successful company started as an idea. Some failed. Others changed the world. Shareholders shared that journey. The goal isn't to predict tomorrow's price. The goal is to own great businesses for the long run. Because over time, great businesses create value. And when the business grows, its shareholders often grow with it. So the next time you press buy, remember, you're not just purchasing a stock. You're buying a tiny piece of a real business.